So let's just, what are you seeing now, right now, in terms of the data you collect? And your data is like, only a week old most times. I
Yeah.
mean, and then are you seeing property as still being one of the great assets for Australians to invest in? Now, let's say if I looked at a Sharp ratio, like if I looked at over a 20-year period, same for stocks and properties and, built-in risk, where's the asset class called real estate sit? Do you guys
Very,
apply
very, very, very good question.
do you apply Sharp ratios to these things?
Yes, you can, or return on equity.
Mm-hmm.
And this is a very critical one because since you can gear property more than the other asset
Mm-hmm.
classes, and presuming it does rise, your return on equity is generally higher than what you can get on any other asset class, perhaps except for Bitcoin right now,
Yeah.
assuming Bitcoin keeps going up. But it's a gearing which enables a massive return on equity to take place in your portfolio.
So just to explain that, what you mean by that is that the amount of money you put in terms of cash,
Yep.
into the property, like you might buy $1 million property, you put 100 grand in, or maybe 200 grand in there, you borrow 800,000.
Yep.
So, and if the thing goes to $1.2 million, you made
You've doubled your money.
100% on your money, on your
Yeah.
200.
You've doubled your actual money that you've put in.
Yeah, that's your return on your equity,
That's right.
as opposed to the return on the total.
Return on the total
Yeah,
asset.
yeah. So you
Yep.
got 20% return on the total asset,
Yep.
but return on your equity is 100%. There's
100%.
not too many asset classes that do that.
Correct.
But in terms of risk, if you risk adjust it, what would you say in terms of that asset class if it's risk adjusted? Because it depends on the date, the cutoff date, of course, the terminal date.
It does. It depends on the time period you're
Yeah.
looking at as well. Of course, these things can go very pear-shaped when you gear up into an asset class that starts going south. So one example, the town of Karratha over in Western Australia. Back in 2012, the median house price in the town of Karratha hit $1 million. We had a commodities bust, essentially, over in WA between 2012 through
Karratha being a
about...
mining town.
Yeah, it's a
Yeah.
mining town. And the median house price fell from $1 million down back to $350,000.
So if you measured the return on equity, and that was the cutoff date, that was the terminal date. You
Yeah,
picked
yeah.
when it was
So if you
350.
picked the worst times
Yeah.
to buy and sell, you were going to you would be wiped out.
Yeah.
Yeah,
Right.
you would be in negative equity, and that's the danger, of course, when you gear up. That said, though, that's an outlier.
Yep.
Like, this doesn't generally happen. But the point being is that, look, yes, property can be volatile, but historically, when we look at least at the capital cities and at the national level, it hasn't been volatile. It's been quite liquid overall. Price movements, no, in a downturn for most capital cities in the course of the year, been no more than, say, 7 to 8% when we have a downturn in a year. They've been, top to bottom, no more than, say, about 15%. That's not to say it's impossible for it to fall more. It's highly unlikely. That's the point I'm making. And generally, when you look at the volatility of those price movements, they're far more stable than what you'll get in equities and precious metals, etc.